Hey everybody, it's Erik co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with a very special guest, Rick Zullo of Equal Partners. Rick, welcome to the podcast.
Thanks for having me, Erik. Excited to be here.
So Rick, you inspired me to go down the Carlota Perez, or you introduced me to the Carlota Perez rabbit hole because you said that her work has influenced your investment thesis. Why don't you talk about that and how it's inspired it?
Yeah. So, I think one of the core beliefs our firm Equal Ventures is that, we're going through this, once in a lifetime, once in a generation transition for a new phase in the innovation cycle. And I think a lot of thinking that supported that has come out of, a book written, almost 20 years ago by the socioeconomist Carlota Perez called Technology Revolutions in Financial Capital. And we think that the core underpinnings of this theory are ultimately going to drive a lot of changes in the way that startups operate and a lot of the changes in the way that the venture industry are going to operate. So it's obviously kind of a loaded message in saying that, but one of the things that we found just utterly fascinating as Rich and I have been getting to know each other over what is now 6-7 years has been this theory of how venture is going to change and how the face of entrepreneurship is going to change. And no one has been better at predicting this than Carlota, and doing that back in the early 2000s. It's astounding to see some of the things that she predicted happening right in the market, right in society today.
Totally. So let's give some sort of, if we were Carlota Perezians or, big believers, a decade ago, how would that have informed our thesis in terms of what to invest in? And how might that inform our thesis today? Let's give first a historical context for how her thesis aligns with, venture and startups in terms of the different phases we've gone through.
Yeah, and I think seeing where we came from is the best way to see where we're going to be going. And Carlota has basically broken out how we think about modern society and innovation, and how society interacts with the financial intermediaries and technology. And her basic core theory is that modern history has been broken up into these innovation cycles where there's every 50 to 70 years some epochal innovation that's so disruptive to the status quo that it changes the way that society operates, and with some form of transformative technology that changes the way that society and industry operate. And we've seen this 4 or 5 times over the last couple hundred years, first with the Industrial Revolution, then with the age of steam and railways, and then steel and electricity, and then more recently with the age of oil, auto, and mass production, and lastly, the seminal Big Bang event for the age of information and telecommunications, with the birth of the mass production microprocessor from Gordon Moore and the team from Intel in the early 70s. And basically each one of these innovation cycles has followed the same exact path through modern history. There's, kind of starts off with a installation phase where it's all about the building blocks of that innovation, occurring in some hyper-localized pod, a group of innovators who are building the kind of infrastructure for that movement, a group of financiers who are really speculating on the potential production value, the potential of that technology, who are supporting it. And these folks make incredible economic gains based on that speculation. And this tends to lead to some type of market frenzy, but, it's all about laying the groundwork for that movement. That midpoint through that cycle, we start to see something called the turning point. And this is where society is really struggling to digest or adapt to the power of the new technology. We start seeing a camp of haves and have-nots, and, this leads to income inequality, disparity, job displacement as the world tries to, really adjust to this new technology paradigm. And this is usually coincided with huge bouts of populism, nationalism, some of the biggest wars that we've seen in modern history, calls for antitrust regulation. And, during the last stage of this cycle, the mass production cycle, this is when the Great Depression and World War II happened. And, that was obviously a very, very scary time for humanity. And these phases can go anywhere from, a couple of years to, a couple of decades. It seems pretty clear to us at Equal Ventures that, we're starting to approach that turning point phase where we've gone from that installation of some really great technologists and, some really innovative financiers backing, great technology hubs, coming out of Cambridge and Silicon Valley, and starting to see that tension build in society. And as Rich and I were looking at each other and, starting to realize that was happening, we thought it started creating an opportunity. And it's amazing that, even in the epilogue of Carlota's book, she predicts that there would be this massive polarization that we would start seeing in society, back in in 2002, as society really struggled to deal with all this information and some of the economic gains coming out of it. So the good news is that once we go through that kind of turning point and the dust settles and, we start to see a transformation of society, which has historically coincided with the best bull runs and best economic prosperity, that we've seen in modern history. And this is when, we have the kind of the golden age post World War II. This is where we really start seeing the benefits of innovation, benefits of technology democratized across a much broader swath. We go from speculative value to production value. And that's really about how do we go and make technology sweat? How do we make sure that the benefits of technology are really making society better, resulting in better economic standards for everybody. And we are of the personal belief that that's, we're really at the cusp of that happening. And we wanted to structure our firm, our team, and our approach, to be the ones that could cater to that next evolution of entrepreneurs deploying technology to society and industry to make those better, rather than being the ones who really focus on investing in the building blocks of technology so that we could be the one to carry the torch forward into that movement.
Yeah. And let's make this more concrete. What are sort of examples of companies or even, sectors or subsectors that wouldn't have been good investments, 10 years ago, but are good investments now, or you're starting to pay more attention to now?
Yeah. And I think, we probably need to, refine the scope a little bit more than just what are good sectors and what are bad sectors. But what we look for and where we think there's an opportunity today where there may not have been, 10 years ago. 10 years ago, we would have considered something like insurance software or, a marketplace for oil and gas field services. That would have seemed niche. And today we're seeing, because technology has become so mainstream, it's become accessible. We have a computer in the hands of nearly every individual in America and, a majority of the folks in the globe, that these opportunities are no longer niche. So, this is how companies like RigUp can be created and be, enormously transformative to the oil and gas value chain by finding ways to actually reduce costs in the supply chain, increase transparency, make the lives of rig workers better. And that's something that I don't think could have been created, 10, 15 years ago. So the way that we and our core belief is, let's go and find those industries that are demonstrating the aha internet moment, the moment that there's such dynamic catalysts that they're going to adopt technology at such a fast rate that it's going to create real opportunity for economic production value, rather than just kind of, another tool to integrate into their existing lives. And we think we like to look for not only these markets that have, significant change, but significant complexity where we feel like we are best compensated for, taking our time to understand the industry and have authentic networks in those industries. And we think that's actually a really different style of investing than someone who has a network, catered to CIOs and CTOs or, great startup engineers and operators. A little bit different than, do you know the team from ExxonMobil and, Halliburton, or do you know, how the insurance industry works, back and forward, like, via connections to folks like Aon and AIG, or, can you do that in transportation logistics? And, do you actually have authentic value add, as well as networks in the transportation logistics industry, which is another one of those sectors that we think is just experiencing rip and replace of infrastructure, a lot of dynamic change, is obviously one of the biggest, most complex markets out there.
Totally. And I'm curious how you think about incumbents versus startups in these spaces, because we saw, as sort of the rise of mobile came, that actually the incumbents, Facebook, Google, et cetera, were actually able to get stronger as a result of that platform shift. How are you thinking about, what will determine whether the incumbents can get stronger, or whether the startups will disrupt them?
Yeah, I mean, I think it comes down to a presence of market power. So, you look at the resources that something like Facebook or Google had extremely strong market positioning, obviously, bordering on monopolistic power. As we look at the industries that we get excited about, we try to make sure that we're understanding the value chain and saying, okay, here are the folks that are disruptible, and here are the folks that we should enable. And, generally there's, in any given industry, there's, some of the stakeholders make a lot of sense to enable, and some of them make a lot of sense to disrupt. So we try to make sure that we take a, fine-tuned understanding to say, all right, for something like the insurance industry, we actually have taken a somewhat contrarian belief that we don't want to disrupt the legacy brokers like Aon, Marsh, and Willis, who are worth collectively over $100 billion. That it actually makes a lot more sense to enable them, given the kind of the size and scope of that population and the relationships that they have with their clients, and the fact that the rip and replace of that as movement is unlikely. But the technology adoption rate of those players is extremely low. So, we believe big and kind of enabling those folks. And on the carrier side of the equation, we believe that there's some opportunities for disruption, that you can actually really bend the risk curve, bring new technology tools, and see the nexus of a digital and financial product by bringing them together. End up achieving economic results that are just not possible within the existing insurers the way they are today. So, we don't like to have a one-size-fits-all approach, which means that we need to go with a relatively slow and measured pace to the way that we're thinking about these markets.
Yeah, that's interesting, because the trend is to, or what's popular is to sort of create a full stack, vertically integrated, just new, like forward in healthcare, or Oscar health insurance, like, is just to sort of want to disrupt. But you're saying no, actually sustaining innovations can, there are certain times where they make more sense and can be really fantastic businesses.
Yeah, and again, it's not one size fits all. We think there are times where the full stack approach makes a ton of sense. One of the very first investments we made in our fund is a company called Block Renovations, and they're building a full stack approach to reinventing the general contracting process, and the economics that they're achieving are really, really compelling. They're the scope of the players that they're going after are relatively small, and they've been able to bend the economic equation really, really heavily. And there's real economic moats there that any value investor looking at that would say, wow, like that's compelling. So we think the market conditions were appropriately applicable for that team to do that. And Coda and Luke are just absolutely phenomenal operators. So, they've certainly executed on that vision. But, there's a lot of other companies that we see in the market who are attacking incumbents with, not much more than digital lipstick on legacy infrastructure. And we think those are some of the companies that, are going to get in trouble. And obviously we're seeing elements of that bear out in the market with, WeWork and others, which, something that we've been thinking about a lot over the course of the last year or two.
And say more about that. How is sort of WeWork, or everything surrounding the paradigm behind it, evolved your thinking?
Yeah, so for us, again, it goes not to looking at where the economics are today, but where the economics could be. And one of the things that we fundamentally believe is that startups are engines for capital. And with that, you're making a thoughtful decision around taking venture capital to develop an economic moat. That when you raise venture money, it shouldn't just be about growth. It should be around how that venture capital is enabling you to have stronger unit economic positioning than your competitors, whether it's network effects or economies of scale, one way or another, that you're using that capital, to demonstrate that you have, a sustainable and permanent competitive edge on your competitors. And as we've looked at, some of those players in the market, won't say individual names, We've seen them using capital solely for kind of customer acquisition, and that works when you're a company with 90% gross margins, or whether you're a company that actually does have network effects. What it doesn't work for is when you're a company that has really thin gross margins, that's competing against incumbents, and that acquiring market share doesn't really do much for you, because it just means that you're racking up losses with worse economic performance than the incumbents, driving up customer acquisition rates, but ultimately not establishing any type of permanence or any type of network effect or any type of moat with that. And we've seen that fairly persistent as folks are coming into some of these industries and realizing that things like loss ratios and insurance really matter, or looking at companies in the trucking industry and realizing that there's certain dynamics in that marketplace that lend themselves probably more towards brokerages than marketplaces. And that's an opinion. We'll see how the market bears out on that. Obviously, some of these companies have raised a lot of money, but at least for us as a firm, like, we're really looking to go and say, all right, we think that this company will have incredible value because it's been able to demonstrate that it can make its claims losses 20% lower than anybody else in that category. And that's what the private equity and hedge fund and corporate guys are going to be excited about buying this company and saying, hey, if we can do this, it'll have tremendous production value, economic production value across our entire company, rather than just being, a means to acquire customers or, a better brand experience, which, really takes some time to understand the kind of actual underlying fundamentals of those companies, which, is the reason why we think that you can't be a generalist at seed stage and, trying to pick these companies out. That you really need to be focused and have, a great network of individuals who can, advise and say, this is actually something really special. This is something that, the incumbents would get really, really excited about, rather than just solely and only a great product experience.
Totally. And you have here in your thesis that legacy markets operate differently. The landscape, these opportunities will look different than those of the past, breaking away from typical venture patterns with a new class of innovators. We gave a couple examples. Maybe go deeper there. If there's another example of an industry that comes to mind where legacy markets will operate differently, perhaps than they have before, or sort of, let's expand more in the thinking behind that.
Yeah. So, my prior firm, Lightbank, the first 6 companies I funded were in 6 different states. I would say, almost exclusively, all those founders were first-time founders. A lot of them had never worked at startups before, and some of those companies, were the most successful ones that I worked at. So, for us, we think really this new phase represents 2 things. One, it requires a different set of capabilities to look at some of these companies. And we talked a little bit of that about, evaluating technology risk and the quality of product versus evaluating kind of the unit economic production and modes that are in place. But I also think that this is really also about the founder. So, I think Rich and I, are deeply passionate about diversity, and, diversity means a lot of things to both of us. But cognitive diversity is a big part of that. And as we look at what the traditional kind of prototypical founder has been from the venture mindset, we think the founders tomorrow have the opportunity to look very, very different than the founders today. And that means folks coming from new geographies, folks coming from non-prototypical backgrounds, folks coming who may not have as much technology acumen as, technology competency has become more mainstream, that maybe the kind of, silver bullet capabilities are, folks who have embedded expertise or relationships, rather than folks who, are amazing engineers. And that it really requires an openness to go and figure out what is founder market fit for that individual opportunity, for that individual industry, rather than us having a predisposition to a certain type of founder profile, which, I think not every venture firm is guilty of this, but, certainly pattern recognition is reinforced, whether, it's known or implicit, to back founders and businesses that, have a look and feel of what's been successful in the past. And it could be that those type of businesses and those type of founders continue to be successful moving forward. But we think that there's an opportunity to work with, founders and businesses that don't fit those profiles, and really lean in on anti-pattern recognition and have a little bit more nuance around that. And that's folks like Kabir Syed from Riskmatch, or Shannon Mike from RigUp, who were definitely non-prototypical founders when they were starting those companies, and both went on to have great success.
Totally. And a couple more Carlota questions. So one is, I'm curious how her framework helps you understand sort of the macro environment, and how that affects your lens as a venture capitalist in terms of timing. And then also, another thing she talks about right now is that we're at the point where we need government to step in, and every 20, 30 years, the beginning of every new revolution, you need markets to sort of filter out, and then you need government to step in, and sort of pick up the pieces a little bit in terms of what hasn't been working. I'm curious if how you think about that as a lens of investor in terms of new businesses that can enable.
Yeah, so I think there's kind of two pieces of that. One, thinking about macro and where we are in the cycle, and then two, the government and societal kind of pushback around some of these economic gains. And I'll tackle the first, and I think it's really, really hard to predict where we are at in the cycle. And I think Carlota puts down 1971 as kind of the big bang moment for this movement, and which would make this kind of run up to the turning point the longest installation phase that we've seen by far. I actually kind of push back a little bit on that. I think the big bang moment wasn't the mass production of the microprocessor in 1971. I think it was the birth of the World Wide Web in 1989, which, when we think about that, we're 30 years into, basically the internet seeing that take off. Obviously, there were earlier iterations of the internet before that, out of DARPA and so forth. But I think 1989, that's really where we're seeing kind of the birth of consumer, internet, and we're 30 years in that cycle, and that seems like a kind of right size timing, based on her theories. The thing that scares me, and it's exciting at the same time, is what if we're dealing with something that it's not these cycles happening every 60 years, that the speed of information, the speed of society, the speed of communication that we have with each other is accelerating so much that we're going to see new cycles on top of each other on, every 10 to 15 years. There's a case to be made that, we had the birth of the computing age, and then we have the birth of the information age with the internet. And, we could say we're going to have the birth of, AI, and then quantum and blockchain, or whatever it is. I think the speed of innovation is happening at such a fast rate because the birth of the internet was this truly fundamental thing that created more information than society had ever dealt with before. So, I think that creates some scary conditions where, we're going to have a lot of winner take all dynamics, that there probably is more need for regulation in the market than there may have been. But, we as consumers also need to police that. But it also means that we have the chance for, the greatest levels of economic prosperity if we do that appropriately. So the larger question that we have is this a minor turning point? Is this going to be, a quick and, relatively, painless one? Or are we going to go and, potentially have something that's as catastrophic as, the Great Depression and World War II? And, that's way above my pay grade to determine whether we're there or not. But, I do like to, go back to kind of the value investing school of thought, and, follow what Howard Marks says, where we can't really time the cycle and know, when exactly the market's going to turn. But we do know where the pendulum is swinging. And it feels that the pendulum has swung pretty far in one direction, that, makes us all need to have a certain level of cautiousness moving forward into 2020. And I think that's, felt pretty pervasively by, a lot in the venture ecosystem. There's a lot of opportunity, but there's a lot of risk at play. And, I think that's how we're seeing the macro market, in our firm. We don't know when it's going to happen, but, you can't have a bull run that goes this long, without having, at least some type of pullback, at some point. And the reality is, I think some of the societal tension pieces, they have the chance to potentially be something much bigger than just an economic recession. And I think we're seeing that play out in the political sphere a little bit.
Totally. And I'm curious if there are any other takeaways that if all venture capitalists had read and be familiar with Carlotta's work, you'd expect the industry to have as a whole. Maybe another way of asking a slightly different question is, earlier I asked you sort of what would be good investments 10 years ago or now that wouldn't be 10 years ago. How might you answer that in 10 years from now? Like, what are examples of things that if we follow the framework, 10 years from now or 20 years from now might be, when we're in the next phase, might be better investments that today would be premature?
So I'll do a little bit of a cop out here, and forgive me for that. I actually think it's less so about, the type of investment. I think it's actually the way how they're operated. So, we talk about distribution of gains, and I think, Carlota is very insistent on kind of society pulling itself together and partnering with government to think about the distribution of those gains. As I look at companies and some of the tech lashback we're seeing is because the economic gains have not been distributed, appropriately. So I think the way that society will move forward and the industry will be moving forward is, maybe a little bit less so to, winner take all, or, compensation structures where, all the economics are associated with, a few at the top, to much more distributed gains, within those companies and to the stakeholders that are that. And I don't think that's happening yet today. And part of that is probably, lack of true, transparency on how the economics of equity, work for startup employees and so forth. But I think that's going to be where the market moves moving forward, and making sure that if, a company is successful, there's lots of success, had by, the employees who made that possible, as well as the financiers of those companies. No problem with people making money, just making sure that, there's everyone gets their chance to participate in that success. And I do think that we're going to see more companies focus on stakeholder enablement. And that's going to be, a lot around the future of work and, platform companies that can go and lead to much better economic results for the individuals on those platforms over the status quo. And I think we're already seeing pieces of that in, labor marketplaces that are finding ways to enable people to have autonomy over their lives, enable them to have better benefits than the incumbents ever, would enable them to have, higher take-home pay than, what they would have otherwise. Because, frankly, there's a lot of people who have been economically displaced over the course of the last decade that, are certainly leading to some of the lashback that we're seeing in today's market.
Totally. And if just taking to some of the examples that you put on your website, one of them is is Amazon, and helping brands compete in the age of Amazon, or enabling brands. What's something you're excited about there?
So, this has been a big hypothesis for us as a firm. There's no company that I find more exciting, more scary than Amazon. I think Jeff Bezos will go down as, potentially the best business mind of all time. And, it's incredible what he's done in the consolidation of market power, and, building the logistics network and density that he's done has just frankly changed the way that we think about consumer products, and how we absorb them on a day-to-day basis. And with that, there's a lot of fallout. So, obviously, kind of the legacy world of retail, isn't going to work. That needs to be completely transformed. And, we believe that there's, some opportunities for what we call is the, rebirth of retail. And, we have a company that we've partnered with in that space called, Leap Retail, that owns, operates, and manages stores for third-party brands that frankly has economics better than any retailer that we can see in the public or private market sphere, because it's been able to compress the value chain and, innovate on the business model and make sure there's better alignment to have these brands working successfully, rather than just kind of being a storefront. And, we also think that there's kind of a retrenchment in core competencies required in what we call the unbundling of retail. So if we look at folks who have really struggled to compete in this Amazon age, as consumers want products, next day, not 3 weeks from now, and, maybe don't want to go to a mall and, Middlesex, New Jersey, that they just would rather have it delivered. The folks who have really struggled making that transition have been folks who have been both brands and retailers at the same time. And there's a few exceptions. Obviously, Nike just the other day decided that it wasn't going to sell on Amazon anymore and is kind of retrenching on this competency. And maybe they're ones who are big enough to do that. But then there's other companies like J. Crew that had fine brands, but really struggled to focus on are they a brand or are they a retailer? And the concept of being a great product development company, being a great digital company, being someone who understands your back-end supply chain and can operate with the flexibility of someone like Allbirds or Outdoor Voices or any of these new DTC oriented startups versus someone who can go and manage, all the competencies of retail, which is not focused on top line growth as much as it is on cost management. You look at what Amazon has done so successfully. It's managing CapEx deployment probably better than any institution ever has in the history of time. Being scrupulous on cost management, being able to hit economies of scale, being able to manage distributed workforces. These are things that aren't exactly top of mind when you're thinking about great product experiences or the way that a startup operates. Which is the reason why we think that there needs to be a permanent kind of unbundling of those two competencies. We also think that there's a lot of innovative business models out there that are frankly being kind of created through aspects of the trade war and other things that we're seeing happening in the global economy. We've been fascinated with business models like Li and Feng, which is a $30 billion Hong Kong-based product development company, and we're fortunate to back a company called Pattern Brands from the founders of Gin Lane that's been able to take that kind of multi-product holding studio concept, fast manufacturing, and being able to spin up new product consumer categories that we're really, really excited about as well.
Totally. I want to close by going into a few other areas you're excited about, and I'll name them, and feel free to go into any ones where you're most excited or as appropriate. So one is you mentioned quality care for families. I assume you mean elder care there. You mentioned bending the risk curve for insurance, and then you also mentioned solving some of society's greatest problems. So I'll let you pick any or all of the ones that you want to speak to.
Yeah, and for us, there's kind of four core themes that we're really anchored in today. And a big part of our firm, hypothesis is thinking through constant catalysts that are creating these permanent changes in the market. So there's always new categories that we're looking at, and can talk about some of those things that we're thinking of. But the four major areas that we look at ourselves and say, wow, there's going to be multiple multi-billion-dollar companies creating these categories, given the impact and importance that they have in society and industry, as well as the degree of change that we're seeing. And those four categories today are kind of transportation, logistics, insurance, the retail in the age of Amazon, and lastly the care economy. And the care economy is certainly senior living is a part of that, but childcare is also a huge part of that. So if you look at what the Department of Health and Human Services recommends families to budget for childcare, it's 7% of their income. If you look at a place like Boston, to be able to afford childcare as a millennial parent in Boston, the average cost of childcare is 77% of pre-tax median millennial income. So you're literally looking at a case where the cost escalation of childcare is 11x of what the government, had recommended as part of when it came up with these policies a long time ago. So we're seeing rampant inflation in things like senior living and childcare, and we're also seeing what we believe is going to be a huge demographic wave of births, as well as people kind of transitioning to senior living homes. It's most folks know that one of the largest age demographics in society is that 65 to 70-year-old cohort of boomers, and there's a lot of reasons why, we get a little concerned about the future of senior living as we look at, what's happening on cost of rising healthcare and, declining social security benefits, and the fact that these individuals may be living longer, but also the fact that, it used to be that a lot of these individuals could go and, live with their kids. That's simply not going to happen in an environment where people are increasingly living in cities, and it's just very, very difficult for folks to, move their parents into, a 2-bedroom apartment, especially given how expensive it is to live in cities. So, there's a level of displacement that's going to happen there, and a bunch of things need to get figured out. And, there's horror stories about what we're seeing in the senior living market that, make us true believers that there needs to be a lot of accountability, accessibility, and improvements in affordability in that world. But we're seeing a lot of those same, secular trends play out in childcare, where, it used to be able that you could rely on your parents to provide helping in childcare. There's something called the dependency ratio in that industry, where, we now have people living further away from their parents than ever before. We're also seeing a lot of advancements in fertility technology that are, making it so that people are having children later on in life. And that's a great thing, but it's also a necessary thing that came out of the fact that a lot of folks in, my age demographic and the folks who are a little bit younger than me, are children of the recession. That, living in urban environments, we just didn't have the bank accounts build up to actually be able to afford kids, especially when it costs you $40,000 to be able to afford childcare. So, as we look at that and seeing the largest cohort of Americans right now being the 25 to 30-year-old group, we actually just think that there's going to be a huge boom in births in the coming years. And we could be wrong about that. But if that does indeed happen, we have nowhere near the amount of supply that we need for childcare. And we're going to see continued cost escalation, which, we start to deal with a lot of really, really tricky questions as a society. If childcare costs start going to $50,000, $60,000 a year, and how that's going to have impacts on individuals and their willingness to work, especially when you're paying close to 40, 50% tax rates in a lot of these urban environments. So, we think a lot needs to be figured out there. We have some theses. We've backed one company in the senior living industry that we haven't announced that we're incredibly excited about, that does really, address accessibility, affordability, and accountability in the senior living industry. And, we're looking to back more within the senior living and childcare verticals.
Totally. It makes a ton of sense. And we've talked a bit about insurance, and we talked a bit about the brands in the age of Amazon. Do you want to speak anything to where you're most excited to invest in trucking logistics?
Yeah. So I think one of the areas that we get really excited about in the trucking world is just enablement of all the independent owners and operators. So, 3.3 million, truck drivers out there. The average truck driver is in their late 50s. The median one doesn't have a college education. Take home pay is extremely low. And these folks work really, really, really hard. So as we go and start thinking about things like autonomous vehicles, which, is a whole nother conversation. You have 3 million Americans who, are working their butts off, are economically displaced. And when it comes to financial products as well as technology products, they just can't compete, despite their hardest efforts with, the larger scale trucking carriers out there. But there's a whole suite of new technology tools that are coming to market, whether it's digital freight brokerages and, new advanced software systems that, I kid you not, the average trucker today, isn't, getting access to modernized software. They're still calling up brokers on the phone. They're still operating on pen and paper. They're still going to, physical load boards at, on, dispatching stations and weigh stations to go and get loads. And, there's a lot of economic opportunity that can be had there, both in making sure that those drivers are more efficient with their trucks, reducing accident rates and improving operations on those trucks, reducing the amount of dead hauls, which is, the amount of time that trucks are driving empty, and also just making it so that these drivers get, a much fairer shake, where you can look at things like insurance, and sometimes we're lucky enough that, 2 areas that we have competency in collide, the average independent owner operator probably pays about 60% more for their insurance than the cost per truck of a large to mid-sized trucking carrier. If you look at what they pay for working capital rates, probably about 60 to 70% higher. You look at leasing, a lot of these folks are going and taking out multiple credit cards, just to be able to afford their first truck, and then paying credit card payments, to do that. So, we see a tremendous amount of opportunity in enabling, this group of several million Americans to create better economic conditions for themselves. And, that's a pretty big market when you're talking about folks who, represent, about 700 billion of economic value. If you can be the ones that enable them, you're going to be able to have a great business.
Yeah, that's awesome. In insurance, trucking logistics, elder care, and brands, and obviously there's more spaces, but especially if you're building there, do make sure to reach out to Rick and Rich, who I've also been lucky to work with. Rick, thank you so much for a great episode. My guest today has been Rick Zullo of Equal Ventures. Rick, thank you for coming on.
Again, Erik, thanks for having me, and you have a good one.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.